Welcome to another episode of Mere Finance and happy Memorial Day weekend. And special salute to the veterans and those that with their lives and their service have made the United States the exemplary country for prosperity and freedom. So don't forget that because of them, we live in a country that we can actually talk about markets, because we have a functional economy, a functional society, then financial markets prosper. So today we're going to talk about the selective bull market that is going on in the United States and the relationship with the rates, if we haven't seen the effect yet of the raise in rates in the last year. But don't forget to subscribe before we begin. So let's dive in. If you do the S&P 500, which is actually 505 securities, stocks, 7 of them, Meta, Amazon, Apple, Microsoft, Google, Tesla, Nvidia, account for almost 90% of the return contribution, while the remaining companies, this graph is actually incorrect, should be 498, actually account only for 10%. So in theory, if you put the S&P 7, so these 7 big stocks, they are delivering a 44% return year to date, while the 498 rest are only up 1%, making the S&P 500 go up 10%, which is extremely selective and actually makes you wonder, are we again in the last decade, where the theme was the large cap mega concentration rally. So why is this happening? Let's see. Let's explore first. AI, artificial intelligence, another word for predictive software. For example, if you have a hotel and you want to predict what demand will look like, what your price should be, you have software that can actually look at models, algorithm. You can simply just call that artificial intelligence and probably boost your stock price or boost your morale. It's just like the .com time or like the crypto bubble. Everything that say crypto, everything that say .com in the late 90s automatically just got a boost in valuations without changing any fundamentals. So I think companies will start looking at any internal software that they have, that they use for demand forecast, for hotel prices, for price exploitation, just to observe and to see how the market reacts. Oh, I'm in the new trend, but actually you have been using the same tool for years and years. So I think that's the hype. The artificial intelligence is a hype, and of course it's a good instrument, but I think it's being overhyped. If you go back to the gold rush, the people that made the money are the ones that supply. They're actually the ones that have the real returns, the real revenue, which are the ones that provided the tools, like the shovels, like the dynamite, like the car wheels to carry all the gold, like the hard hat, like the equipment for those people that seeking their fortune in gold will use. Those were the ones that actually benefited. And it's the same now. The ones that are going to benefit are not those that are creating artificial intelligence and like just been going with the trend. It's those that provide the tools for the so-called artificial intelligence, like data and cloud centers, microchips manufacturing, and also as well the hardware that is used to create the process that actually creates the artificial intelligence. So if we look at the S&P 7, like we call the Nvidia, the Tesla, the Google, the Amazon, the Apple, the Microsoft, we can see like they are in these segments, in the ones that provide that for the artificial intelligence or the ones that use it. For example, Apple, Meta, and Tesla, they are using the artificial intelligence for their own products because they already have it integrated. Nvidia, AMD, especially Nvidia, is the one creating the data centers, the manufacturing of the chips, and Amazon, Microsoft are the ones that are, and Google are the ones that are providing the cloud and data services. So that's when you see the benefits of being in artificial intelligence. But we haven't seen yet any change in the actual business of companies. Yeah, you see IBM say that they are going to hire freezing and 7,700 jobs are going to be cut, but we're going to see if the software that they have is better than artificial intelligence. And this also has something to do with rates. Why? Because those companies, the ones that are actually having real return revenues, those are the biggest companies that are able to absorb easily the rates. And actually, if you look at the underlying of the economy is actually suffering, but because of the artificial intelligence hype and the rates being absorbed by the big mega caps, we haven't seen the real effect of in the economy. So this is the graph. We see that there is 425 bips that the Fed Reserve raised rates in the last year. And there could be a lag, probably 12 months. Even the Fed Reserve president, one of the Fed president speakers, Jefferson, said that 1 year is too small of a time frame to review to see the actual effect of interest rates in the overall economy. But I think you are seeing it already in certain markets, just like the job market in the technology space. You can see that it drops in employment there, but in other parts of the economy is still very strong. So we are still yet to see the lag. And the lag is basically because we live in an economy where mortgage rates are especially low, at 3% when most houses were bought. But also, most people own around 58% of home equity. So it's not to leverage. Then when you have mortgages which are fixed rate 30 years, then the new effect of rates is actually not going into the housing market yet. You can also see corporate debt. Now corporations use swaps in order to hedge for the interest rates increases. And a lot of floating securities were issued in 2023. Why? Because they understand that, okay, rates might stay higher for longer, but if we can do 5 or 7 or 10 year notes, we know rates are going to drop because something's going to happen in the economy. The Fed is going to cut, so then our floating rate will just go down. And also, if you had long-term rates for your bonds in debt, in 2019, 2020, when it was almost zero, then your 10, 15, 20, 30-year bond debt is like at 1, 2, 3% is super low. So you still don't see the effect in corporations. And also private credit has growing and growing. Now there's a $3 trillion ready to be deployed in case, commercial real estate just completely shatters. Private credit will go and buy some of the stuff. Anything that goes wrong in the economy, private credit is there. It's one of the asset classes that have been growing tremendously. I think it's one of those that will also try to help the economy, not to the shareholders, but also for their own sake. They will grab those assets that are maybe overvalued, and they will step in and also attack that effect of interest rates when the economy is crumbling. Because we can see the lags. So the 6-month lag is 125 bips, because 6 months ago, the effective Fed fund rates was at 3.83, currently sits around 5%, so you can see 125 bips. A year ago, it was at 0.83, so we still have to see the 425 bips that will change, and 18 months ago, it was almost zero. So in 18 months, we'll actually see the 500 bips of changes in the economy with interest rates. That's why in a video in the past, we understood and we provided evidence of why the real thermometer of the economy is the Russell 2000. Because the Russell 2000 shows the actual economy, not the mega caps that are concentrated. And you can see here, in the last 5 years, the S&P 500 is up 54%, while the Russell 2000 is up 8.92%. It's a extreme gap of 46% between both indices, too strong. And then you can see then that the real economy is not actually performing as well, because this is a selective bull market. And this is what happened. This year it was actually doing well. The Russell 2000 was outperforming the S&P 500 up until the weekend of March 8th, 9th, and 10th, when Silicon Valley Bank collapsed. So then the Fed started giving more funds into the market. So then again, large caps were the ones that benefited, and you can see the change, completely change in the trend. The S&P 500 now is up for the year almost 10%, as we said before, and the Russell 2000 is barely up 18 bips. So you're better off just buying treasuries or just putting your market in a savings account, because you put in the Russell 2000, which is the actual economy, then you are getting nothing. It's dead money. So I hope this is informative, how artificial intelligence is making this a selective bull market, how interest rates are yet to be seen in the economy at full scale, and how the real thermometer of the economy is the Russell 2000, and that's the one we have to check in a few months when actually the rates get into the economy, and we can see actually a completely destruction or recession, deep recession in the economy. So thank you for watching, and please let us know what you think about this. Don't forget to subscribe. Thank you.